There's another business owner.
What's up, people? How you guys doing? And welcome to another episode of Market Watch.
Yes, sir.
I'm your boy, Erik T. Jackson, and that's your other boy.
Eddie Chinea, glad to be back again, man. Love to be doing this week in, week out.
Yes, sir. Yes, sir. We bringing the people what they want, that good stuff. We are a financial news show, information. Uh, Everything we do, it's for you. It's for you, the public. And uh, we've been put in this position to help others and to sort of guide people and have fun doing it. And this is one of the ways we're doing it. Take it for what it's worth. Uh, However you feel, leave them in the comments, good, bad, or indifferent. We love you.
Oh
And
yeah.
we are glad to be doing this show. This is number 5, if I'm not mistaken.
Yeah, that's crazy how
Uh,
fast the week's gonna go by,
yeah,
man.
man. Yeah, man. Yeah, man. Uh, so this week we're gonna give you guys some good stuff. We're gonna talk about portfolios again. We're gonna get into uh yields, dividend yields, investing, uh, invested yields, and that type of thing. We'll talk a little bit about some sports contracts that are out there and what that means for the players, the clubs, things like that. And we'll have some fun. Let's get started. Eddie, let's talk about portfolios, man. And I know you want to talk about defensive portfolios. So talk to us about what it takes to build a defensive portfolio, my brother.
So, if you keep listening to the talking heads on TV, man,
Hmm.
and all this stuff goes hand in hand, you start thinking about, the R word that nobody ever wants to talk about. You know what I mean? That recession, right? The recession's coming. There's bound to be a recession, right? You got the yield curves inverting, right?
Hmm.
So we're talking about being defensive, right? We're trying to find some defensive uh, investments that we can kind of stand the test of time if things turn, if we do fall to a recession and things make a turn take a turn for the worse.
So
We want to be able
defensive
to have
is
some things that, yeah, that can actually, try to hold up, right? So you're talking like some blue chip stocks, things that, you know, consumer staples, things that people are going to buy regardless, right? So people are still going to be drinking Coca-Cola. People are still going to be going to, Kroger and Walmart and HEB. They're still going to be buying Campbell's soup, so just trying to get a little more defensive as far as your investment strategy.
so
And
is defensive stocks sort of like, would you consider them pandemic busters, or was that like a little further over?
Man, so as far as the pandemic, but I don't know if you saw today, man. Carvana's in bad shape, man. Them
Okay,
jokers
I
are
did
down
not.
like 98% year to date since
Wow.
January, and lost another 40% today. I know it sounds crazy, like how's something down 137%? We got to just think it could go down infinitely 40% every day, right?
Yep.
But so you talk about some of those pandemic busters, man. Some of them, are trying to make a rally to come back, and some of them are just, man, like Carvana, boy, just bad, bad, bad. So, but anyway, we're talking about going back to that defensive stuff, man. There are other things other than just stocks or funds or things that you can buy. You know, what I mean, to be defensive, right? So we
Yep.
talked about a little bit about commodities, right? So,
Hmm.
maybe putting into some gold.
Yeah.
Try to find some mutual funds, ETFs, cash equivalents, right? Nothing wrong with being in cash if you're worried about what the market's going to do, or when you don't know what to do, it's okay to sit in cash and sit on the sideline.
Yeah.
It's not a bad thing. Like I said, I try to explain to people if you bought, today was January 1st, and you bought $1,000 worth of Amazon. Right? Amazon drops 10%, so now your $1,000 investment's worth 900. Well, now you're hoping for Amazon to bounce back that 10% just to get back to even,
Yep.
and then for it to go up another 10% on top of that. So I mean, you've lost 10%, so you need it to regain 20% before you finally start to turn that profit. You know what I mean?
Exactly. Yep.
So being able to, or being willing to say, you know what, man, I'm going to sit on some of this cash, and nobody ever knows when the bottom of the market's going to hit, right? So nobody knows, to time the market is next to impossible, right?
Yes.
Up, down, sideways, nobody knows any of that.
Right.
So once you start to see, the bottom hit, and you start to see that maybe there's a rally starting to form again, man, and now it's time to jump back in. Well, now you've saved yourself from a lot of those losses, and you've got cash to be able to buy it. Some rock bottom prices.
Yeah.
Buying into some bonds. One person I know hates when I bring it up. My dad, my father, hates when I talk about bonds. I'm having a conversation with them. My parents are retired, man, and I'm having a conversation with them yesterday, day before yesterday, and I said, Dad, there's no need to be as aggressive now, man. You're aggressive when you're getting going, and you're trying to reach that milestone and trying to get there. I said, well, you've gotten there. So it's okay to, to peel back and not be so great. You don't need those 20, 30, 40% gains. Don't get me wrong. They're great.
Yeah.
But you were retired. This is money that, it's got to last you now, right? So he's like, I understand. I hear what you're saying. It goes against everything I believe in as an investor and everything. I said, Dad, it's okay, man. Like I said, if it keeps your money safe, being into, having some money in bonds, and if it keeps your money safe for a little bit until markets start to settle down, again, that's just another way to be defensive as far as, your portfolio and your investment strategy.
Absolutely. Absolutely. So a defensive portfolio can consist of gold, silver, cash, bonds, and give me some stocks, man. Give me some
some defensive deals, man. So when you talk about defensive, a lot of times talk healthcare.
Okay.
All right, people always gonna need to be in a healthcare. Campbell's soup, right? So when the country falls into a recession and people are making less money, more people out of jobs, less people are going out to eat, more people are starting to cook at home. You know what I mean?
Yeah.
So, I'm just using Campbell's soup as an example, but, people now, Campbell's soup, people are going to be buying it because they're not eating out as much. You know what I mean?
Absolutely.
So then some of the things that people are going to buy regardless are going to stand the test time, right? People are going to continue to drink Coke and Pepsi.
Right.
You know what I mean?
Right.
So
Absolutely.
things like that, right? So, some of those defensive deals are going to be, like I said, your healthcare, just really, so, your consumer staples.
Yeah, definitely. Like Johnson & Johnson products.
Man, it's funny you say that, man, because I was just talking to my dad about Johnson & Johnson, looking at it, man, I really, really like Johnson & Johnson right now.
Yeah, me too.
Again, company has been around forever, not going anywhere.
Yep.
Right? When you talk about consumer staples, we're talking about the exact opposite of some of those, right? Consumer discretionary, right? So your Nikes
Right.
and things like that people are like, hey, man, mom's out of work right now. She's looking for a job, and, we can't afford to go buy Nikes.
Exactly.
But we can damn sure afford to go buy some of this, some of these groceries at Kroger and at H-E-B
and toilet tissue and toilet paper.
Yeah, man.
Yeah.
Because people don't realize, not that people don't realize,
napkins.
but it doesn't hit home until it actually hits home, right? So when those people, somebody actually in the household, you go from two incomes down to one income, now it's really time to cut back, So a lot of times where it's like, oh yeah, I know we need to cut back, but if you really don't need to cut back, you don't really see, how it really is going to affect you because you really don't have to.
Yep.
As soon as that two incomes becomes one income, now you start saying like, oh man, time to cut back. You know what I mean? Can't eat out as much. You know what I mean? Can't go out. No, we can't go out and go to the mall. We can't go to urban air.
Yeah. Did I lose you? Was it my internet or yours? Hey, hey, man. Knock, knock. Who's there? Well, people. Yeah, so just like Eddie was saying, building a defensive portfolio is more important when you're uh, older, when you have your things, when you don't, there's no need to be as aggressive, So he'll probably be logging back in here in a second. So I'm gonna just keep talking until he does. All right. And we'll talk about this defensive portfolio. But so I sort of put it synonymous with the stocks as pandemic busters, but it's more than just that. It's the staples. It's the things that are gonna continue to grow in time, even when there's not a pandemic. So it's everything that pandemic busters are and more. You know, I was just, uh, you hear me?
Yeah, I'm back on. I don't know what happened. My internet just cut out. I was like, my Google screen went black. Zoom cut out. Like, what is going on here, man? Is that man that canceled me already? We in the
Yep.
cancel culture, man. We in cancel.
We said something wrong.
Yeah, man. Somebody Zoom and got
Hey,
mad at us.
the trigger word was Campbell's soup.
Yeah, God no, man. Pandemic busters. Zoom got mad. Like, hey, we ain't no pandemic buster, man.
Yeah, yeah, no, I was just reiterating what a defensive portfolio was, in my estimation, compared to what you was letting us know. And you know, I feel uh like you were saying, when you're older, retired or close to retired, then a defensive portfolio is more important.
Yeah, be a
When
little
you're
more
younger,
conservative.
you don't
Yeah,
you
yeah.
don't need such a defensive portfolio.
Yeah, you're younger, you know what I mean? It's all based on people's, you know what I mean, risk tolerance, right? Not
Absolutely.
everybody's okay with it, you know, and one of those things is that people have to keep in mind is if you are afraid to lose that 10%, then you know what I mean? That means you probably have less tolerance for risk. So based on, you know,
If you
bunch of
scared,
factors, all kinds of questionnaires and everything. I tell you what you are, but yeah, I'm a proponent of when you're younger, man, try to be as aggressive as possible, man, and get after it. And then as you know what I mean, start
absolutely.
getting into, you know,
If you,
those years where you're leading into retirement, man, it's
mhm,
time to pull back a little bit. You don't need to
yeah,
be as
pull back. Yeah, if you're
moderate.
scared to lose 10% though, man, you don't need to be in the market.
Yeah, I
If
mean,
you're
you're gonna lose
scared to lose
10%.
10%, yeah, just put your money in a savings account, put it in the
Yeah,
bank.
go get a CD or something like that, right? I mean,
Absolutely.
yeah, but you know, there are people out there that are, you know, and that check the market every day and like, oh my God, I'm losing money, I'm losing money.
Yeah,
Like, man, you know, we're in this for the long haul, so
yeah,
let's not freak out, and let's not lose
absolutely. Because
faith. You know what I mean?
when it's green and you're up, that's what people need to see both sides of the coin and understand or have perspective that it's not always going to be red, not always going to be green.
That's right. And then look, what would I say? It ain't all bad, but it ain't all good, right?
Yeah,
So, you
yeah,
know, I'm
absolutely.
no English major, I'm no English professor by any means, but look, I know that I'm a math guy, and I know I like to see commas being added, not taken away.
Already.
Like everybody else, that yeah, I
Yeah,
don't want to be losing money like everybody else, but understand that, you know, again, this is a long-term deal, and with the
yes.
market being cyclical, it's going to go up
Mhm.
and it's going to go down, and
Yeah,
when it goes down, there's chances, you know, buying opportunities, and when it goes up, you
yeah,
know, when it's down, it's never as bad as it seems, and when you're up, it's never as good as it seems, you know.
yeah. And I will say this, like if you are a solo investor, like if you don't have someone doing it for you, you're doing it for yourself, and you're buying stocks that you maybe have researched and they're losing. In a bull market, you losing. In a bear market, you losing. Then maybe you should try defensive stocks or a defensive
Yeah,
portfolio.
man, you know, so food and beverages, right? The
You
food and
might not be able to
stability
pick
of
them
them.
too well.
I'm with you, yeah. And a lot of times, I mean, when it comes down to that stuff, sometimes, man, it is okay to ask for help, man, and go
Yeah.
seek somebody that knows. You know what I mean?
Hmm.
Maybe it's just better for you to, you know what I mean, to jump in something like an ETF or you know something that's kind of matching the market, just
Yeah.
something's a little safer. But you know, when you talk about defensive, man, tobacco, alcohol,
Yeah.
especially in time of recession, things you know, times get stressful. People
Yeah.
gonna still smoke cigarettes, they're still gonna be drinking.
Yeah.
Right, so your household products, things of that sort, just ways to be
Right.
able to find companies that you know going to stand the test of time,
Yeah.
you know, blue chip companies, right? Some, you know, even more so ones that are paying dividends.
So I like
Right.
I like the word defensive. So you have a defensive portfolio. So it's guarding against losing your money.
Yeah, yeah. I mean, essentially, it is. Now, that's not to say that just because you have a defensive portfolio that you're not going, you know, that it's not those companies won't be affected as well.
Hmm.
But understand that you know you have I guess the likelihood of you losing as much is greatly reduced when you start being more defensive and putting into things, right? So, you know, the
Yes.
dollar starts to drop, right? Gold starts to appreciate. So, you know,
Hmm.
you're in gold. And that's
Hmm.
another thing with diversifying the portfolio, making sure that, you know, you have
Hmm.
assets that are negatively correlated, right? So when these
Hmm.
are up, these might be down, but that's fine because when it flips, right? So you're able
Hmm.
to still kind of capitalize on some gains. May not be as much as you like, but again, it's a way to kind of, you know, manage risk inside of within your
Already.
portfolio.
Already. So then if you have 100,000 to burn and you want to be aggressive, that's an offensive portfolio.
You know what, man? It's just being aggressive. You know what I mean?
I'm trying to.
Yeah, just be. Realistically, that's a good question because I've never heard of it having an offensive portfolio, but defensive, just I mean, like I said, protect yourself, and a lot of that comes too, man. Just finding solid companies, man. There's a lot of those guys that pay, decent dividends, man. So you can,
Right.
you continue to make money on top of your money.
Yeah.
Uh, it's a way for these companies to give back, to the people that are investing in them, and they share in their profits, and so if you can find some of those again, especially with a company something like 3M that's paying almost $6 a year per share.
Mm-hmm.
Right? I mean, that's good. If you had one share, I mean, they're going to mail you $1.50 every quarter. Doesn't sound like a bunch.
IEP $8 a year.
Yeah, you know what I mean. So if you look at stuff like that, where $6 a year doesn't sound like much. Well, now you start saying, hey, you know what? Well, guess what? I got 1,000 shares.
Mm-hmm.
So now that's $1,500 a quarter.
And that's what you want to work up to. Absolutely.
Yeah, and some of that stuff ends up, like I was telling my dad, I said, Dad, you end up getting these, some of these dividend paying stocks, man, that pay good dividends and good dividend yields. I mean, that stuff there where you're retired, where you don't have to take money from your retirement as far as your withdrawals and worry about paying bills. You know what I mean? If you're making $6,000 a year in dividends, that alone could help pay little things, right? Your internet bill, right? Your electricity, your water.
Yep.
You know what I mean?
Yep.
And now I don't have to use, what I'm taking from my withdrawals to have to pay for those bills. So
right.
Again, just another way to be able to be defensive, man. There are plenty of companies out there that pay good dividends and take care of their their investors.
Yeah, and we will get into some dividends probably next show, because I really want to dive deep into a lot of different dividends, because with dividends, man, you can touch on a lot of different aspects of a stock, and I want to do that like one show.
Yeah, man, we'll put that on. Yeah, we'll make one show of it, man. Just really dig in deep, man, and explain to everybody out there, like, hey, why these dividends, why companies pay dividends, what a dividend is, why they're paying them, and why it's good to have some of your money in that stuff.
So let's talk about an inverted yield curve. So that sounds like a vocabulary word to me. Does it have a
SAT word, right?
Yeah.
SAT prep class, man. Yeah. So we talk about yield curves, right? You're talking about the 10-year U.S. Treasury, right, and the 2-year. All right.
Okay.
So when they are not inverted, you usually have the 10-year. It's got a higher yield, right? So longer duration, 10 years before it matures. So you're taking more risk, so naturally it should come with a higher return, right? So increased risk should equate to higher return. Whereas if you are going with a 2-year, right, less risk for interest rates to change, less risk, you could expect less of a return. Well, what happens is, like what's going on now, is you have the 10-year and the 2-year have inverted. So now the 2-year 2-year bonds are now paying a higher interest rate than what the 10 years are paying. Right. And now, while it has never been, I can't say predictive, but it is highly correlated to recessions. I think the only time that it's ever like inverted like that, and we didn't go into recession, I think was back in the 60s. You know what I mean? So when everybody keeps saying, oh man, we're on the brink of recession,
so what I sort of noticed right away is that the 2-year yield is giving you a higher yield in a bear market, and a 10-year, I guess, in a bull market. Is that sort of right? I mean, do they invert based on the type of market it is?
I think what happens is, as again, this comes down to a lot of the economic factors, right? So GDP, right? Economic growth is slowing down, right? You've got rates being raised, and this, I mean, all the extra things that are going on in the market right now. Yeah. And as these yields start to invert, right? So the 2 years paying more than the 10-year, people started, oh man, freaking out, right? So it affects the markets, man. Oh man, what's going to happen? Are they going to continue to raise rates? When are they going to taper it off? I mean, there's so many aspects that go into that stuff. But if everybody can just understand that when the yield curve is inverted, it's because the 2-year is paying a higher yield than the 10-year. And that's usually a sign that we are probably headed into at least economic slowdown, if not, a recession. Now, the recession could be short-lived. I mean, it could be the first quarter of 2023, and guess what? Going into this, Q2 of 2023, and we're coming out of it. The market starts to rebound. It could be 6 months, could be 2 quarters. There's times also where
repeat.
We could already have that stuff priced in right now. You know what I mean? With the way the market has been just this year alone, that a lot of stuff priced in so that if this yield curve stays inverted and 2023 starts off a little bit rocky, it may not be as long because again we've kind of bared and grin and bared it through all most of 2022.
Okay, say that again so people can really get that.
Uh,
The 2-year becomes a higher yield, or say that again.
Yeah, so when you have the inverted yield curve, all right,
Mm-hmm.
that's when you have the rate that a 2-year treasury note, the rate that they're paying is or rises above what you're going to get on the 10-year note. All right. So when the 2-year starts to pay more than what the 10-year does,
That's when it's inverted.
something's up. You know what I mean?
Okay.
Like, why is it that this is a short term, fixed income asset that I'm about to invest in, and the short term is paying me more than what it is for the long term. You figure
Yeah.
long term, there's more risk involved there, right? Because you're waiting 10 years for this thing to mature, we'll just say.
Yeah.
Well, you would think that because I'm taking more risk, I should be getting paid a higher yield for that, or I should be making more interest on that than I would be if I'm only doing it for 2 years. Well,
Right.
and when they invert, the 2 years paying more than the 10-year, that's how you know, hey man, what's going on? So when that yield curve inversion happens, when they invert, it has preceded when that stuff happened. It has preceded every recession. I think it said since like the 1960s.
It's been like that.
Yeah, I mean, so they said that the
Yeah.
first, I think, clear inversion in 15 years, I think, was this year in July. Yeah, July of 2022.
Yeah.
And then there were, some more brief, more shallow inversions back in, I believe, August of 2019, I believe it was. And then again, earlier this year in April. So when that stuff happens, again,
I wonder if there was an inversion in '08 during the housing market collapse.
that wouldn't surprise me.
Right. Right. It wouldn't surprise me either, but I'm just thinking out loud.
Let's see. Hey, man, look, let me tell you this. Something else that, the public, you guys that watch us, man, that are viewing us, understand this. We don't have all the answers. So as he's asking a question like that, guess what? I have this thing called the Google machine on my computer, and I jump on that thing and I look it up, man. I have no problem saying that, if I don't know, I don't know, but I'll try to get you an answer.
Hey, man.
So it says here, so an inverted yield curve appeared in 2006.
Okay.
So, I mean, what were we in the housing crisis? Like, that was like right before the bubble popped, right?
Yeah.
2006,
Yeah.
2008. So,
2006 was right before. Yeah.
yeah. So,
Hmm. So it knew something was coming up.
yeah, man. And again,
Is that
it's
how some of these big companies know when recessions are happening also, so they can do with their money, they can move their money around based on a recession about to happen, based on
yeah.
the,
I
the
mean, well, you
inverted
look
yield
at it. I
curve.
mean, you look at some of these companies, man. It's just, I mean, they continue to lay people off. Pepsi, I believe, is laying off hundreds of employees. I mean, it's happening more and more, which tells me again, unemployment rate is going to start to go up a little bit, and naturally in a recession, that's usually what happens. And there
And
are a
you
lot
see it
of
every day because these companies are laying people off left and right.
man, it seems like, yeah. And again, the craziest thing is so counterintuitive that, with the Fed raising rates and everything, oh man, employment rates are still high, right? So we need unemployment. So we need people in America to lose jobs so the economy can get better. I was talking to my dad
So
about that the other day. And I said, man, that's so counterintuitive. That matters. When you think about it logically, that makes absolutely no sense.
no sense.
Like,
It,
don't you want people in America working? Don't you want, what I mean, for the economy
it
to thrive and to flourish?
absolutely. It
Yes, but
seems
again,
counterproductive, right?
yeah, man, it's
Like that's
crazy.
yeah, and yet I can see. I mean, if it's based on too much money being in the economy and they're trying to slow it down, then I can see it. I can see, well, you got to lay people off to slow the economy down,
Yeah.
But if they were trying to speed up the economy, then laying people off would be counterintuitive. Yeah.
Yeah, well, they're when they're ready to try to stimulate some economic growth again, that's when they will cut rates.
Yeah.
And when they cut rates, just makes money more available, right? So they increase the money supply,
Okay.
and and then again, that's why I said it's cyclical, man. So when we start doing, country starts doing too well, what do? Man, we got to raise rates, tighten up the money supply, right?
All right.
Things get
So
back
so let me ask
to
you this,
normal,
man.
quote unquote normal, whatever that is.
Before we move on, man, let
Yep.
me let me get your expert opinion, your expert idea. So so as Joe Blow guy that just trying to make it in this world, what philosophy should I have? I mean, I know you know, what philosophy should I have when dealing with inverted curves and recessions and layoffs? You know, I might be putting you on the spot, brother.
No,
Uh,
I mean, look, that's a really good question, and I think that when you start hearing that stuff, man, it can get scary.
yeah,
You know what I mean? So, biggest deal is again, try to keep a job. You know what I mean? As much as possible. I mean,
absolutely.
some of those things are out of your control. I get that sometimes. Uh, and don't stop contributing. Like continue to contribute, especially if you're in some form of IRA,
Yes, sir.
401k. Yeah, continue to contribute that stuff, man, because it's going to pay off long term. But again, don't for one, don't be afraid to go out and seek help. You know what I mean, and ask people. But for the people that are, like I said, Joe Blow, who doesn't know, look, I don't know how this recession is going to affect me. I have no idea what you're talking about when you're saying yield curves and dividends
Yeah,
and all that stuff. Man, look, worst case scenario, continue to contribute, continue to invest, and if nothing else, at least continue to put it in and hold it in cash until things start to stabilize. Because again, I'm not trying to be the bearer of bad news. I've been telling people for probably the last 2, 3 years that we're due for some form of a recession. I mean,
hmm
I mean, the market has been hot. Earnings estimates and earnings for company earnings have just been. I mean, it's crazy these multiples that they're trading at. That we've been due for something like this for a little bit, and and it's coming. So as far as philosophy, man, I think just stay the course. Do not stop contributing. And when in doubt, it's okay to sit in cash. It is okay. Or again, start to try to build a defensive portfolio, things that are going to uh, try to stay in the test of time, right? So again, the
hmm
consumer staples, right? Personal products,
yeah,
tobacco, right? Your Procter and Gambles, your Johnson and Johnsons. These are just
healthcare.
again examples. I'm not telling anybody to go out there and go buy these, but just ways to be able to find a way to again stay diversified
Yep.
and do it in a sense where things are going to these companies are going to stand up or stand that test of time where they are going to be able to not drop as much in value because there are things that people still going to buy, whether we're in a recession or we're in a
hmm
boom, things that people are still going to be buying.
Already, already. Okay. All right. So, uh, good deal on inverted yield curve, man. That's good to know. You explained it pretty well, bro. You know.
Hope so, man. I know some of the stuff is very high level, and even sometimes I have to go through and read about it, man, and
Mhm.
then learn, and you know what I mean. But anytime we can try to, I don't want to say dumb it down for everybody, but anytime we can
Right.
try to put in, simplify it
Simplify it.
in
Yeah.
simple terms, man, so
Yep.
people can understand what's going on. So now you're sitting down, hey, morning coffee, sitting around, man, at the job or something, hanging around the water cooler, and somebody starts saying, "Oh yeah, man, here we're going to a recession." Now you can go and say, "Yeah, man," because the 2 year and the 10 year yield, inversion happened, and it's always
Yeah.
preceded a recession since the '60s. It's been a pretty good
Absolutely.
indicator of.
You're gonna have me
So
look. I'm gonna look out for that. One last question about that.
yeah,
So how does an average person find out if it's inverted or not?
man, listen to the news, man. And every guy
Okay.
you can get a bunch of information off of Yahoo. All right, go
Okay.
to finance.yahoo.com and you can
hmm
check all this stuff. There's another one that I personally like. They do have a paid version, but it's called the FT. So FT.com.
Okay.
And if you go to FT.com and I believe you go to markets and go to market data, you can scroll down to where it says bonds and it'll show you what the 2 year is paying and the yield of the 10 year. And
Yeah.
if you see that the 2 year is higher than the 10 year, well, then you know that
It's
the curves
inverted.
have been
Yeah.
inverted.
And
Yeah.
then you know something about to happen.
Something, yeah, something's happening, and it's
Yeah.
never a good deal. Something like that is on the horizon. It's never great for
Yeah.
uh,
And then the thing is, now that you have the information, what are you gonna do with it? Like you have the information, now do with it what you will. You know what
that's
I'm saying?
true.
Some people make wise decisions, some people make, won't. But
It's one of those, right? You can lead a horse to water, right? You can't make him
hmm
drink.
absolutely,
And unfortunately, that
absolutely.
happens more often than we ever care to admit. But
Mhm.
when it does happen, like I said, don't you heard it here. I'll say you heard it here first, but you heard from us, and we kind of try to give you the forewarning or try to
Yes,
put you on
sir.
the game so that you understand what's going on and try to kind of maneuver through the murky waters, man. Because it's going. There are times that recession hits, it can get tough.
Absolutely, absolutely. Let's pivot into dividends, dividend yields. Like I said, I want to spend a whole show on dividends, but let's sort of introduce dividends, the dividend yield. You what is it? Uh, when you look at it, how important it is. to buying or not buying a stock and those type of things. What's up with the dividend yield?
I got you. All right. So, I mean, I'll start right off. I mean, we'll just talk about what a dividend is, and we'll do
Okay.
that quickly, right? So,
Yes, sir.
anytime a company says that they pay a dividend, a lot of times what it is a payment that they're making. Basically, what they're doing is they're sharing the profits that the company made, and
Hmm.
they're sharing it back with the people that are shareholders, stockholders, right? People that have invested in the company. All
Exactly.
right. A lot of times they're paying. There's different types of dividends, but what they do is they pay it usually on a regular basis, and it's just another way for you to kind of add to your returns from investing in, in that company, or investing in a basket of companies that
Okay.
pay dividends.
Yeah.
So where the yield comes into place, right? So you talk about yield. I give you guys the literal definition here, where it's a financial ratio that shows the return an investor would earn from an investment based solely on dividend payments. So
Uh-huh.
if the investment that you made, you invested in Walmart, we'll just say, and Walmart pays a 4% dividend yield. If Walmart, you bought it at $100, and at the end of the year it's still at $100, we still would have earned, right, 4% off of that dividend yield,
Yeah.
because they pay a 4% dividend. So
Yeah.
it's a way for you to kind of gauge, hey man, how much am I getting, you know what I mean, percentage wise on my
Right.
money, if this thing were to not make a single dollar, if it
Hmm.
was just sitting there and it stayed at $100 per share every day, 250 trading days a year. If the dividend yield was 4%, well then you've made at least 4% because you've gotten your those dividend checks. But
Right.
there's a way to deal with dividend checks also. It's called dripping the account, right? So if you have a company that pays a dividend, we'll just say 3M.
Hmm.
3M pays a dividend.
Hmm.
If you only own one share of 3M and they pay $1.50 a quarter per share, that means they're going to mail you a check for $1.50. Well, rather than them sending you that check for $1.50, go ahead and take that $1.50 and just tell them, hey, do me a favor and reinvest it. So what they'll do is reinvest it, and they'll buy you another little fractional piece of a share with that. Whatever, however many shares that $1.50 will get you is what they're going to purchase, right? So it's called dripping it, right? Dividend reinvestment program, and it's a
Absolutely.
way for you to just say, hey, don't send me that $13 check, that
Hmm.
$27 check.
Hmm.
I don't need that right now. Just go ahead and reinvest it. And as you continue to reinvest those dividends, you start to see like, man, I was able to buy an extra, 5 shares over the last 10 years. I would get an extra
Right.
5 shares because of the dividend, that it was
So
paying.
yeah, so the reinvestment is going to be a fraction of a whole share.
Yeah.
So
So
we
I
have
mean, we'll just say
ten.
it's
Yeah.
something, if they paid you $1 and
Yeah.
it was $10, right? So they're going to buy you a tenth of a
A
share.
tenth of a share.
Yeah.
Absolutely. Yeah. Okay. Okay. So uh good. Now that we know what yields are and just know that, just associate yield with percentage. Dividend yield, dividend percentage that they pay you is how I sort of look at it. Uh so how important is knowing or let's just say the I guess it's more important the higher the yield is, or do
So
you
a
still
high
have to look
yield,
at other
yeah, a high
factors?
yield can be good. I will say
Okay.
this though, what you don't want, I mean, while they can be attractive, those high yields,
Yeah.
uh, some of the times that stuff can come at the expense of like potential growth of the company, right?
Okay.
So you figure that every dollar that a company is going to be paying in dividends to people that are invested, to the shareholders,
Hmm.
is $1 that that company is not reinvesting back into the business.
Right.
You know what I mean?
Right.
So why that high dividend yield, yes, comes out and it's like, oh man, that's good. You got to understand, is it a company that can continue to grow organically and still be able to pay out that high dividend yield, right? So I think I was reading that like General Electric, right? They do, manufacturing, energy. They have, those two divisions.
Hmm.
When they started to like start underperforming from like 2015 to 2018, the stock price falls, right?
Yep.
Because earnings fall, stock price starts to fall. Well, you have a dividend yield that was, we'll just say was at 3%, right? And now it goes
Hmm.
up to 5%. Well, it's like, oh man, the dividend yield just increased, but that came at the expense of the stock price dropping. So it's not always necessarily just because it has a high yield doesn't mean that it is a great, company to go and invest in.
Yeah.
So don't want people to get fooled by saying, oh man, this thing's got a 12% dividend yield. Yeah, well, if 12%, if it started off the year at a 6% dividend yield, it's probably because price of that stock has come down.
Yeah.
Right? They're still paying at that same dividend. So naturally that yield percentage is going to increase,
Hmm.
but at the expense of, the stock price, dropping in value.
Right. Right. So uh stock yields that go down, is that always a bad thing, or
If the yield goes down, I mean, not necessarily, because it could be that price is going up. You know what I mean?
okay?
Or sometimes it could be because that yield's coming down because, hey, we had to cut our dividend, right? So now
Yeah.
again, that could be a warning sign that, hey, they're not doing as good, or maybe they're cutting it because they want to go back to, trying to reinvest,
Hmm.
back into the company, right? Trying to grow that company organically by not having to borrow from
Hmm.
banks and, issue new shares and things of that sort. So when you look at that dividend yield, you're trying to find out how
So
much it's, how does it compare in relation to what the stock price is?
okay.
I mean, so if stock price starts to drop, yeah, that yield goes up. But again, are you worried about getting those dividends, or are you worried about that stock price being, you know what I mean? So it's kind of a twofold deal that, yeah, you want a good dividend yield, but you
Right.
also want that stock to continue to appreciate, because otherwise, why would you invest in it? You know what I mean?
Absolutely. So and I know the answer to this, but do all companies have give dividends?
No,
Okay.
no, not, yeah, not all of them pay dividends, and some of them pay dividends, and they're very, very small.
Hmm.
Some pay very, very good dividends. So I mean, it just depends on the company.
Okay.
But it's not always, yeah, not every company is going to pay a dividend out.
And you just
Uh,
got to
so
you've got to research the ticker symbol and find
mhm.
out which ones give out dividends, and look at the yield, and so and the percentage that it gives out. And sometimes they, like you said, they are very small, and other times they, they might seem pretty decent. You want to look at some stocks that actually give out dividends?
Yeah, for sure. Well, one of
Yeah.
them, I mean, I think it was just something that I've got my kids invested in, something that, that I'm invested in personally, is
Hmm.
3M. It's kind of taken a beating, this year.
Okay.
But when you get to looking at,
So
uh,
so it's what, MMM?
yep,
Yep.
yep, MMM, look at it, and they pay something like $5.94, just on, it's like $1.49 a quarter is what they pay
Okay.
in dividends.
Okay.
Let's see here. I'm trying to
3M
see if it's
company.
kind of direct people to where they can find. Let's see if it's under financials. I'm on finance.yahoo.com to see if where I can find the where it shows the dividend and all that stuff.
Okay.
I don't see it anywhere on here. I always see it because I got my charting software, so it just naturally, what I mean, it pops up.
Yeah. Oh, okay.
I'll find it on here. But
Yeah.
anyway, 3M is for sure. Again, they've kind of taken a beating this year, but they pay a very, very, very good dividend.
So
I think
it's
it's very,
it's a
very good.
dollar 49, so basically $1.50. Yeah, you was
Yeah,
right.
so you figure $1.50 for every share that you own. If you own 10
Hmm.
shares, you're gonna mail you a check for $15. Or you reinvest that $15, you know what I mean, like we talked about. So, oh, here it is right there. Duh, it's right on it. So when you go to finance.yahoo.com,
Hmm.
type in MMM, it's gonna pop up, and then it is on the summary page,
Yeah.
and it is just to the left of the chart, the bottom of the chart, just to the left of that. It'll say forward dividend and yield. So pays 5.96 or $5.96 a year, almost
Yeah.
$6 a year,
Yeah.
and with a 4.78% dividend yield.
Yeah. And the stock price is
126.35 right now. The 52-week high, or the 52-week range, has been anywhere from, I believe, as low as 107.07
okay.
and was as high as about 181, almost $182 a
When
share.
was
So
okay, so that was just the high point in the last 52 weeks.
yeah, last 52 weeks. And
Okay.
they fought some, fighting some legal battles, as far as,
Hmm.
they had some things with the soldiers and the earplugs. So been, fighting that stuff. But
Okay.
again, solid
So
company, been around forever. They got patents on a bunch of things. You know what I mean? I mean, it's 3M. Post notes. I mean, how many? You're in education, man. How many times you use a post-it note?
oh man, I love post-it notes, by
So
the
do
way.
I. I hate when
Yeah.
people take my post-it notes and start making little paper airplanes. One of my kids do it all the time, man. Like, leave my post-its alone.
Yeah. Last year, before they moved us out of our old office, my entire desk was full of post-it notes. So one day I'm trying to clean them all off. I'm trying to figure out what, I can get rid of. I needed all that information. I couldn't get rid of nothing. Unless I just wrote them on like a notepad or something, but I love
Yeah,
post-it notes.
I know. It's so easy to jot something down. Look, I've got
Yeah.
one sitting around on my computer screen right now, man.
My
It's talking about
to-do list is
529
gonna be,
accounts.
yep, on a post-it note. Uh,
Yeah, man.
look at IEP for me. Tell the people,
IEP,
yeah, yeah. What's that
IEP,
looking like?
Icon Enterprises, dividend. Yeah, man. Woo-wee. Them jokers are paying $8 a year,
Eight
$2
bucks a year,
a
$2
quarter.
a quarter.
Yeah, almost 16% yield. I mean, so you're talking $8. You take that $8 yield or $8 dividend that they pay and
Hmm.
divide by the current stock price of $50.45.
Hmm.
It'll give you almost 16% yield. So if
Yeah,
nothing else, if you bought right now at $50.45 a share, if this was January 1 and they pay them out right fiscal year
yep,
January to December, I mean you would make 16%. I mean you would make $8
yeah,
a year
yeah.
alone. Just
Absolutely,
I mean
already.
on the
And
dividend.
I think I bought it at 54 bucks is where I bought it at. And it's been above that and it's below that currently, I believe. But I've made, I've had it over a year, so I've made $8 on all the shares I have already. So,
And beat that.
yeah, that's gravy for me. Let's look at something that let's look at Johnson and Johnson, which I know the yield is a lot smaller, but it's practical. It's what people buy. It's one of our defensive portfolio stocks. So let's look at Johnson and Johnson and see what they paying out.
Yeah, I'll pull that up right now, man. I'm looking at IEP. I kind of like that.
Yeah,
I
I mean, I tell you, I
kind of
love it.
like that a bunch, man.
I am. I'm loading up on it. If it keeps going down, absolutely.
I mean, it's trading kind of sideways
Yeah, yeah, I
a little
know,
bit,
but
man. But I mean,
I'll get on all I have. Yeah, yeah,
that's
I'll get on.
exactly. I mean, it's been trading sideways now for months, almost.
Hmm.
I mean, actually, for almost a year to the date, almost been trading kind of sideways, man. Been trading this little channel,
Yeah, yeah,
and at 8%, you can't beat. I mean, they've missed out on
right.
earnings, and matter of fact, they were just came out of oversold territory. So from where it's at now, at $50 a share, I mean, you're looking at probably 52 would be the next one, and it's got a gap to fill. So I mean,
Yeah,
fills that gap. You're looking at probably $53, and you're looking at $3 a share, give or take, almost.
absolutely.
So let's look it up. J and J. Here we go. Johnson and Johnson. Johnson and Johnson. Their most recent dividend was paid. Actually, they just paid it out yesterday.
Okay.
$1.13. So you take that
Already
$1.13, multiply it by 4, and it gives you what the yearly dividend is.
452.
Yep. And then if you take that 452 and you divide it by uh, the current share price of it's 177.17.
Yeah.
So a little more on the expensive side,
Hmm.
but I mean, again, they're paying, 2.55% as far as a dividend yield.
Right.
And I was looking at them like, again, because it's one that I was talking to my father about and something that I'm adding to my portfolio personally that I mean, let me go back because I think the last time that they missed on earnings, still going back, there it
Hmm.
is, 2011.
Oh, wow. So that's 11 years.
So you're talking, yeah, I mean, you're talking 11 years running
Yeah.
where their earnings, they have met or exceeded, expectations of street. And so again, solid company,
Yep.
uh, you know, not going anywhere,
The
right? People still
company,
having babies, people still using Johnson Johnson baby oil, right? Baby lotion,
man,
tearless shampoo, right? I can still, I mean, when I think about it, can smell it, right? Washing my children's hair when they were younger,
bro.
and the smell of Johnson Johnson baby shampoo,
Uh-huh.
man.
Yeah, I know.
Johnson Johnson baby powder. I mean,
It
it's
gets you, man.
it
That
does takes you
smell in
back.
itself, yeah. I mean, that's something that, and I'll tell people this, even, at the I mean, and expensive is relative, but 177 is probably expensive for most regular people. If it's a stock that is going to stand the test of time, if it's sort of what we consider a pandemic buster, a defensive stock, I would say, buy it over time. You don't have to get 30 shares in
Yeah, little
one
by little,
time.
man. Keep
Yeah.
hacking away at it. You know what I
But
mean? I'm
yeah,
definitely not telling anybody to go and say, "Oh man, I got 25,000 to buy all Johnson Johnson."
exactly.
Definitely not saying that, but I mean to own some shares of Johnson Johnson is
Yeah.
definitely not going to hurt. So
Yeah.
I mean, year to date right now, it is up. And again, mind you, 2022 has not been a great year. It
Yeah.
is still up 4%, and it was up as high as, let's see here. got as high as 8% for a little while there, and it's, I mean, it started to rally back.
Mm-hmm.
So I mean, to be up 4% on the year, add to that the 2.5% that you get in the dividend yield. I mean, you're looking at, you've made 6%. I mean,
Already.
6.5%. That's
Already.
saying a hell of a lot more than what banks are paying, right? You know what I mean? When you look at it like that, man, a lot more than what a bank's going to pay you right now to put some money in
Absolutely.
there.
And then when you project like 5, 10 years in the future, come on, man. You know, it's
Look,
gonna
I'll
be
go
up.
back and I'll tell you what over the last 5 years, what this thing has grown.
Yeah. And the best way to project for the future is look to the past.
Oh yeah. And while we can never, I mean, we're never going to be able to predict it how we want.
Right.
It, definitely if you want to know where something's kind of going, history repeats itself. They say, well, no, you can't know where it's going if you don't know where it's been.
Where
Right?
it's been, exactly.
So look, I'm going back to September of 15 to today. You're
7
talking
years.
1,800 trading days since then. That thing is up 96%, almost 96.5% since
Mm,
2000, September of 2015.
mm.
That's
Makes me makes
you know
me
what I
kick
mean?
myself.
I'm with you, but you got to think about it too, right? So let's go back, and you talk about going back 7 years. 7 years, it was at almost $90 a share, which
Yeah.
at the time, I mean, it's still $90 a share. For the average investor, probably
Was
can't afford to go and buy
exactly. That was pretty
100
high.
shares of that. You
Yep.
know what I mean? 100 shares at $90 a piece, man. We're looking at $9,000.
Yep.
And if
Yep.
all you had was $9,000, I mean, you're putting all your eggs in one basket.
Right.
Now, would it have paid off? Yeah, it for sure would have paid off.
Double your
But there
money
would be
for
times
sure.
where it got scary, right? So you're talking about,
Mm-hmm.
when a pandemic hit, I mean, even still, you were up at $90 a share.
Mm-hmm.
You got in at $90 a share, and at the pandemic, it got as low. I mean, the low was 109. So you still would have been up. You know what I mean? So, I mean, I can't even
$20
say
a
any of that.
share.
Yeah, you
Mm-hmm.
still would have been up. You know what I
Yep.
mean?
Yep.
And you think now, man, the thing is 177. Even if you gotten in when COVID first hit and the pandemic happened,
Mm-hmm.
you'd still be up, $70 a share, $50 a share.
Let's look at let's look at uh I guess an in vogue stock that everybody probably should have in their portfolio. Let's look at Apple. See
Oh
what their
yeah.
dividend share
So I'll tell you, Apple
about.
does not pay a very big dividend. I'll tell you that right now.
Mm-hmm.
Uh, I mean, I think there was some like 20 something cents, 23 cents.
Okay.
That's on the, okay, well, let's say 23, that's 23 cents on the quarter. All right. So take that, multiply it by 4, so you get 92 cents a year.
Yeah.
All
Yeah.
right. And it's currently trading at $140 a share.
Mm-hmm.
Uh, so, but again, you talk about something that's, kind of defensive. I mean, Apple, people are just they still buy Apple products, and Apple, apparently Apple has something about them where, they are able to stand test time. People love Apple products.
Love them, right?
I love Apple products. I
I
can't
do
even
too.
lie. Yeah, you know what I
Mm-hmm.
mean?
Mm-hmm. So
And this
so
will make you sick. How
go
about
ahead.
this? You go back to 2016. Take a guess what Apple was trading at back then.
So it split. So it got us before the split, it got as high as what, 400, something like that. Oh, so I do remember it went up a hell of a lot, but
They split
16
7
was
for
like
1, and
six.
then they split 4 for 1 again. But I'm
So
just talking based on split adjusted and everything. So it's trading at almost $20 a share.
it was $20 a share in 16.
Well, you got to go back and you have to, again, that's split adjusted, right? So they
Yeah. That's
split 4
before
for
it
everything.
went up to $400.
Yeah. Isn't that
So it
crazy?
split twice since then, or once?
So they split once in 2014, a 7 for 1 split, and then they split again in August of 2020 for a 4 for 1 split.
So does the 7-for-1 split take them down to like $20, $30 where they were in
So
16?
if you go 16, well, you would right before they split, they were trading at, we'll just say $23 a share, right?
Yeah.
So multiply that by 7, that'll tell you what it was trading at.
Okay. Yeah.
Really?
So roughly 160
Yeah. So you divide that
bucks.
by 7 for 1 split, you divide that by 7. So now it's down to $20, give or take. And then price starts to go up, and then they happen again, they split again 4 for 1, divide the stock price by 4, and it'll tell you more
So did anything
price.
happen? Did anything happen with the dividend yield when they split? Did it go up, go down? Do you know?
Prior to them splitting, yeah. So when they split, it's going to also that split will also be affect. It will affect the dividend.
Okay.
You know what I mean? So if you go back to right before they split 7-for-1, they were paying a dividend of $3.29, and then they split 7-for-1, so that dividend came down to 47 cents. But while people are like, oh my God, it came down $3, a share on their dividend, but you also just got 7 shares for every one that you owned.
Yeah. So
I mean,
my thing is, did it affect the yield or no? Because the
not
percentage
because
keeps it the
it's
same.
all relative. You know what I mean?
Yeah.
So there's just if we split 7-for-1, you're just going to divide everything by 7.
Hmm.
All right.
But the
So when we
percentage
talk
stayed the
about,
same.
yeah, the percentage is going to stay the same. So I mean, if you had right something that was $10 share, you had 10 shares, something that splits 10-for-1. All right. So now
Okay.
you have 100 shares. You take the dividend divided by 10,
Yeah.
which is going to, again. So if the dividend was
It's
10
gonna
cents, right?
split the,
Yeah. So it's
yeah,
going to keep that same yield.
yeah, the yield will stay the same,
What's
but
going
the
to affect the
money will
yield is
split.
the price of the stock, or if they cut the dividend. That's what's really going to affect the yield.
Okay. Okay. Yeah. Uh okay, let's get into that then. So uh I guess there's a few different reasons why companies would either slice it or just stop paying a dividend altogether. Could you give me one or two, maybe?
Yeah. So it goes, and I'll tell you, Carnival Cruise Line, man. Carnival Cruise Line was paying a dividend that was very, very good. Matter of fact, I know people that were invested in them because of the dividend.
Yeah.
And then once pandemic hit and COVID shut everything down,
Nope.
they stopped paying. Their last dividend payment was February 20th of 2020, and they
Okay.
were paying 50 cents a share. So $2 a year.
Okay. Yeah,
And
that was decent.
yeah, $2 a year. I mean,
Hmm.
$2 a year, and your stock price is at $43.
Yeah.
Yeah, I mean, you can't beat that.
So so the pandemic happened, the
Almost a five
shutdown
percent
happened
yield.
in March. So
Yeah, so
they didn't even give people a month or two. Well, I guess
no,
the quarter, so the next one would have been in May. So yeah, they was like, once
yeah, they
May
paid
hit,
it
we're not paying.
March. They paid it in March. So April, May, June, they would have paid it again. They ideally would have paid it again.
Hmm. Hmm.
And
Yeah.
again, things like that happen, right? So they're not making as much money. There's no profit to share with the shareholders. You know what I mean? There's no
Right.
profit to be able to share with the stakeholders. So
Right.
they cut their dividend and not paying anymore. Hopefully they get back to paying it. It'd be great. Love to see Carnival Cruise Line get
On
back
their
on that high
feet.
horse, starting to
Yeah.
trade a little sideways here. So hopefully it's finally found some solid support where it can take off and run again. But man, dude, I mean, the fall from grace, COVID was not good to the cruise lines, man.
At all.
From almost $52 a share down to $8.89 a share right now. What it's trading at?
Bro, did you hear about the passenger who fell off of Carnival Cruise Line? And he didn't die. Let me just put it out there. He was in the water. He was treading water for 20 hours
Gosh
before before they
almighty.
before they found him. Yeah.
And
He was
survived.
yeah, he said that he survived, I guess tree bark or something he was gnawing
Floating on it.
on, and yeah, and he said that the seawater, it was left a bad taste in his mouth, but he was dehydrated. They said when they got him, he collapsed. He probably wouldn't have made it another hour,
Wow.
but it was 20 hours. So,
And we went on a cruise with the family, took the kids and everything. We went to Royal Caribbean, man. And that was the one thing my wife was truly, truly worried about. Like,
yep,
man, what if one of the kids fall off? And
that's what I'm
so,
worried about. I'm thinking about a Disney cruise, but I'm worried.
man, that's something I want to go on, man. I love Disney.
Me too. Me
Love
too.
Disney.
Hmm.
Their stock has not been great, but
Right.
they stopped paying dividend also.
They did, huh?
Yep.
Yeah. I mean, it seems like they are on the way back, but I don't know if they've started paying a dividend again. But that their stock seems like it
It's in
might
a
be.
steady decline, man. I'm telling you, yeah. So from March of 2021, man, it has been kind of when it started thinking it was gonna make a rebound, man, and then
Yeah.
boom, just getting punished, punished, punished. It's finding a lot of support now, right around the range where it's at right now, between $93 a share. But
Yeah. Yeah.
man, something's got to give. Like, come on, need those.
Yeah.
Anybody's look. I'm invested in Disney. My wife actually still has actual Disney shareholder certificates.
Certificate,
Yeah,
that's
so
crazy.
for all you guys that are not
That are
Disney Plus
millennials.
subscribers, go ahead and subscribe to that Disney Plus for me, man. Go ahead and get
Yeah.
the stock back to back to where it needs to be.
Absolutely. I was gonna ask because I do have Disney Plus 'cause I just love Disney. But you know, when they had plus when they introduced it, I thought that it would be a big boom to their stock price because I had their stock at the time Disney Plus came out. I don't have Disney stock anymore, but I did when Disney Plus came out, and yeah, it traded sideways for a long time when I had it, you know, and so
Yeah,
I sold it, but you know,
they were paying
uh,
almost 2.4% as far as dividend yield, man. They're paying like 350 a year before they stop
okay,
paying.
yeah,
But
yeah,
Disney, again, regardless of what the price is right now, man, Disney is a company that I believe Disney's not going anywhere.
absolutely, you're
You know what I
right.
mean? Like Disney's going to be around for years to come, man. So,
Good.
if they do manage to, I don't know that it's going to continue to fall from here. Or again, can't predict any of that stuff. But
Yeah,
it is a company that I believe in. I mean, they're not going anywhere. They're
absolutely.
going to be around for a while. So it's something that
Good. So I
continue to
hope
invest in.
everybody has gotten some good value, regarding these dividend yields. Let's jump into something that's pretty interesting, pretty fun. I mean, let's talk a few sports icons and some of the contracts that they signed.
Yeah. Hey, before you jump into that, you were
Hmm.
just talking about a Disney cruise, man. I'm looking at the news here now, man. That Walt Disney Cruise Line is set to return to the Bahamas, the Caribbean, and Mexico in 2024. So there it is, man. That's what we needed.
Okay, yeah,
Yeah,
definitely.
departures from Florida, Texas, Louisiana, and California. Bookings open to the public December 15th. So 8 days from today, you guys go and book that Disney cruise
Hey man,
2024, going to Bahamas, Caribbean, and to Mexico, man. That's good to hear. That's good news.
yeah, that is good to know. Let's look at Justin Verlander, man. The boy left the Astros and he signed a 2-year, $86.6 million contract with the Mets, man. Uh
I'm not taking anything away from what that man's capable of doing because I cannot do what Justin Verlander does. I'm not
I
taking
hear
away.
you. I hear you.
But 80 something $1 million for 2 years to get on that mound.
Do you think the Astros were fools for not paying him that money?
Nope.
Good.
Not
I don't
one bit.
either.
And
I
here's why I say that, man.
Yeah.
Springer.
Hmm.
You don't like our contract? See ya. Correa, you don't like our contract? See ya. And guess what?
Keep
They
on
had
winning, baby.
a beat. That's right. Just keep winning, man. Like Al Davis, just win, baby.
Yeah, yeah, no, and I absolutely that the franchise is doing some things right, and the reason that I don't mind him moving on is because of the depth we have. Like we had like 6 starting pitchers, maybe 7 when McCullers came back. Like
Yep.
7 legit starting pitchers. Like none of them
Yep.
sucked. So
Yep.
yeah, I mean we don't need to pay $90 million. Although I feel like he's going to be really good, but I think even the Mets still need pitching depth. They have him and they have Scherzer,
Yeah, well,
and
and he's
that's
been
not going to get
injured
it
too.
done.
You know what I mean? And
Yeah,
like Verlander's been on the mound consistently for the Astros either. I mean, he's 39 years old. You know what I
yeah,
mean? About to be 40 years old coming up next year, February.
yeah.
And I mean that's not to say that he's not worth every one of those 86
Right.
point $6 million that he got. But
Another contract. Aaron Judge, 9 years, 360 million.
yeah.
I thought they were done giving out 10-year, $400 million contracts.
No, man, are you kidding me? Look at what Machado got.
I hit no,
Juan Soto, Machado, Tatis. These are all dudes that here we go. I got it pulled up right now, man. San Diego Padres players and contracts. All right. Tatis becomes a free agent in 2035. Hold on. You ready?
and becomes a grandfather in
Right?
2035.
14-year, $340 million contract.
Yeah, but wasn't
Machado,
that
10
like,
year, $300 million contract. Yu Darvish, 6 year, 126. Joe Musgrove, 5 year, $100 million.
bro,
Crazy.
bro,
That's crazy.
we gotta get some of these pro athletes to buy into your hedge fund, man.
I mean, yeah, you ain't lying. Here's the crazy thing about this stuff, though, man. is you're talking about almost $1 billion in just 5 guys.
Yeah,
You know what I mean? It's
a
like when
billion,
Trout and all
man.
these guys got with a B.
Yeah,
Like is anybody, if somebody gets a $500 million contract, a $500 million contract, is there anybody in the world that is worth $500 million to play a sport?
yeah. Is 60 home runs worth that kind of money?
I mean,
You know,
can he do it consistently? Can he do that, year in and year out? I'm not taking
right.
anything away from the man. What again? Those guys do things that I can never imagine doing in baseball.
Yeah, yeah. I can't hit 60-mile-per-hour ball, much less 100.
You know what I mean? Yeah. But how
Yeah.
about this? You want to do all that, and you're going to pay money, right? Because it draws in the fans, and you
Hmm.
sell tickets, you fill the stadium, you sell
Hmm.
memorabilia, you sell right. That's
Yeah.
great.
Yeah, absolutely.
Hey man, that kid had to be coached by somebody. That boy had to be taught by somebody. I can't
Absolutely.
get broke off with like 100th of that contract. I can't get
Man,
I can't get
yeah.
50 grand.
I taught you to hit that slider, and you know what I'm saying?
Yeah,
That's
man.
not worth a half a percent.
Here we are, you know what I mean, having to deal with knuckleheads in the school system, right? And these jokers go on, and again, they are masters of the craft. They're, extraordinary at what they do.
Absolutely.
But I'm an extraordinary teacher. I can't get
Absolutely,
a
man.
5 year. I'll sign a 5 year,
Hey,
$350 million contract.
I could do an art with the best of them, baby.
You ain't lying. Teach math, you know what I mean? Just let me know. I can do it. Yeah,
Yeah, yeah.
crazy, man.
Hey, we had a couple more names, man. We run out of time, big dog. It
Man.
was fun, bro.
And
You
every
know what
week
I'm
is
saying?
fun, dude. It's always
Yeah,
good,
man.
man.
It's
I think
always,
people realize that there's a backstory to us also, man, that we did coach together. You know what I mean? That it's not just
yeah,
some random dude you met online. It's, you know what I mean?
absolutely.
That there is there's for sure a backstory to it all,
Yeah,
man.
man. Yeah, we had some fun times together, brother. I would have liked to made the playoffs at Sterling. I think we was
Oh,
what a game short. Hey, Yates came back on us that
well,
game. I
dude,
was
that
upset.
burns. Look, you know what we went home with that night? A consolation prize of a timeout. Because I remember OC telling me, "Yo, Eddie, want to call timeout here?" I'm like, "No, I don't want to give him time to draw up a trick play, nothing." He's like,
Something
"No,
like that.
just
Yeah, yeah.
back him up, back him up."
That
And I'll
made
never
sense.
forget.
Yeah.
I'll never forget that Joker. I mean, just selling wolf tickets at corner. Coach, I ain't had a ball call me in 3 weeks. I ain't had a ball call me in 3 weeks. Drop back
And he
over the
was
top. He couldn't have placed it in that dude's hand any better. Touchdown,
and
we lose.
he was actually wasn't he was playing better.
He was
He had
playing great.
gotten much better.
He
Yeah,
was.
week by week, and he just dropped the ball on that one.
That dude
We ain't
just
calling your name, my brother, but you know who you are
That's you know exactly who you are. You're the reason why they did not take the VA and rename that thing Cochinea Villa Apartments.
already.
You know what I mean? The VA should have been. They told me, hey, boy, we'd have beat them. They'd have renamed the VA after me. And I said,
Yeah, yeah,
no,
that would have been huge for you, bro.
that's one. Hey, you know what? And that's one of those deals where you live and learn. Next time I'm calling that timeout,
Yeah,
settle our
man.
kids down,
Yeah,
back them up.
yeah.
Look, we ain't even rush quarterback.
No need to.
I'm going to rush 2, and we're going to drop 9. And
Yeah,
let the balls go. Dude, we had just scored. We got the
yep,
2-point conversion. That
yep.
boy Chaz was toting the rock at fullback. I mean,
Killing it. Yeah,
yeah, man, it was a
yeah,
good game.
yeah. Yes, sir.
Good game.
All right, man.
All right, brother.
Next
Next week.
week, we'll talk about dividends and maybe talk about Deion Sanders and his contract. But
Yes, sir. Yeah, and everybody, like I said, stay on the lookout, man. Follow us, EightOne Capital. Join the Facebook group. We got the giveaway coming up,
yes,
sports
sir.
memorabilia, and I actually got another gift that we're giving away. A buddy of mine I work with started a business with his daughter, man. So I've heard to do it as a giveaway, also help
All right,
support
buddy.
another small business. So stay on the lookout for that.
Yes, sir. Till next time, boy.
Yes,
Talk
sir,
to you
brother.
later.
Take care, man. I'll see you next week.
All right, buddy.
I'm here.
Yeah.